and may now speak to any other organizers or panelists on the line. When you are ready.
Okay, well, I'll start the recording and then we can talk. Yeah. So I'll begin by saying all rights are reserved and copyrighted to Options Animal, and the content of this presentation should not be considered a recommendation to buy or sell security. All information is intended for educational purposes only and in no way should be considered investment advice. Options involve risk and are not suitable for all investors. All rights and obligations of options instruments should be fully understood by individual investors before entering any trade. All right. So this is like I said, an 8.9 class. And so the instructor can talk about anything they want to. In the past, I've gone through, I put this up for your reference. So if you go in the archives, you'll know that each one of these is different. And this is, by the way, if you go to Ask Eric, and then in the sticky section, so there's some sticky posts in here, there's the 8.9. So all the titles of the 8.9 classes that are there. Some of these, I think, might be well suited to be in lower levels. For example, this one here, leveraging lessons from Warren Buffett. I think that might be good in level 2, but unfortunately, it's only available to you folks in level 8. Well, good for you. We'll keep it away from the other guys, right? So today I was debating about what to talk about, and two potential topics came to mind. And one was how to build a trade tracker to keep track of your cost basis. And the other one was going over protective puts. And I did a class, I think it was in our summit in 2012, where I talked about protective puts. And I went through and I looked at some different strategies for puts. So when I talk about the dials on going up and down, in an options chain, when you look at an options chain, you can go vertically. Those are different strikes. Or the other dial is horizontal and you can go right to left. That would be different expiration series. And I looked at that for protected puts. I looked at potentially going at the money, in the money, or out of the money for options that fit the basic application of protective puts. And that is making sure that you have 45 days of time value. I'm sorry, I got a dog who is scratching my door because she doesn't like the door closed. But then my wife's going to come and close the door because it's noisy. Okay, so protected puts, you have the choice of going at the money, in the money, or out of the money. And what I did was I went through different scenarios where the stock made a different move. So I did all three cases with equities that made either a very bullish move, a stagnant move, or a bearish move. And the results are not surprising. The results are that with regards to the moneyness goes, when a stock went down a lot, the in the money strategy did the best, and the out of the money strategy did not do as well. And conversely, if the stock went up a lot, the out of the money strategy did the best, and the in the money strategy did the worst. And the mediocre strategy was the kind of the one in the middle. And that's where my conclusion came down to, unless you're trying to protect your cost basis, because you're not good. If you're buying puts, you're not good at picking whether the stock is going to be very bullish or bearish. If you do, it's luck. The answer, I mean, it's fine. If you want to go deep in the money, but you will lose the most amount of money if the stock goes up. If you have very bearish indicators, then maybe that's the appropriate trade. But I'm telling you that me personally, I can't pick where a stock's going to go. Not in the short term anyways. I'm better at it over the long term. So, but in the next 6 weeks or so, I mean, nobody has a clue where stocks are going to go. And so at the money for a protected put tends to work out best for me. Anyway, so I just talked myself out of doing that presentation because that's basically the answer. I can go through the presentation and show it to you. And like I said, the conclusion is in the money does best if the stock goes down, out of the money does best if the stock goes up. The truth is you don't know. So at the money, unless you're trying to protect your cost basis, and let's say you bought the stock, well, depending on where your stock is, if it's higher or lower, you may need more or less protection. If you bought the stock down here and now it's up here, earnings coming, you want to buy a protected put, buying a put somewhere way out of the money down around where you paid for the stock might be prudent. And then you're only protecting the stock purchase price, not necessarily your profits, but it's going to be cheaper in the long run. The other key on that aspect is to make sure that you have enough time on your protected puts to be able to adjust them or close them. And shorter term puts leave you with less opportunity for adjustment. And you're probably going to be closing those shorter term puts. Longer term puts do give you more flexibility and potentially to sell puts against it. So that's the gist of that deep, what I called it a closer look at protected puts, and I'm not going to present it. That was one of the ones I was going to present. The other one is one that I wanted to present, and this is one that I don't know that it really is a level 8 topic, but I do think that it's important, and I don't know where else in the program we really talk to you about it, and that is the importance of tracking your trade and your cost basis. I am curious to wonder, those of you that are doing it, how you do it. And I'll be honest with you, I'm not 100% sure how the other instructors do it. Do they keep a running total? Do they do it in their head? I am not smart enough to do it in my head. My guess is they probably write it up in the trade. So whenever they make an adjustment, they just note what the cost basis is. Well, Scott uses an Excel spreadsheet. Well, that's so my point here would be to be a little bit more thorough when I go through this and hopefully have this as a resource for you when we, if you wanted to go back and look at the archive again. So let's proceed forward and go through it. Sounds like you guys are going to be good with that. So, the key to success using the options animal method, it is going to require adjusting. Roughly about 33%, about a third of all of your trades Cool. About a third of all of my trades and all of the animal trades require adjusting. It might be a little bit higher. Maybe it's 40%, but it's in that range. Somewhere about a third of, it's not quite half, and it's definitely more than 20%. So about a third of all the trades. So if you place 3 trades, on average, if you're using the typical sort of approach that we use, a third of them are going to require adjustment. So the ones that close at their primary exit, you really don't need to keep track of the cost basis on those, especially if they close at a primary exit. You don't need to track anything. In fact, I don't. When I place an initial trade, I generally don't start off by tracking, although sometimes I do, because it helps me in doing the calculations that I like to do, like the return on risk and the annualized return on risk, and that sort of stuff, risk rewards amount. So calculating all that, I do sometimes do them on my initial trades, but not all of them. But certainly once I make an adjustment, then I'll go back and I'll do that. I'll do one. So in order to adjust, you do need to know what your cost basis is. In order to get someplace, the first thing you have to know is where you're at. So what do I own this stock for? What do I own? What do I have invested into this position? Now, some people may not use it, and you may get to a point where you don't need it. If you're looking, I always tell people the thing that really matters is that number in the bottom right-hand corner of your account that shows your profit and loss. That's really what matters. And your broker may give you the ability to look by equity. So I could go look at Apple. I can see my net profitable, and What it doesn't show though is that normally they're not. Um, they either show you open trades or they'll show you year to date or a certain range. But you may have a running trade that's been open for longer than a year, or maybe over a calendar year. And if it only does year to date or open trades, it's not going to count the trades that have closed. And so I do think it's prudent, by the way, to have that goal, that percentage goal that you need to try and get on track to hit, which should be driven by your long-term goal. So by a certain date, you need to get to a certain number, and that's what you want to try and get to. And then sort of doing the math to what's going to get you there. And it does have to be realistic. And I didn't want to turn this into a goal setting, situation, but we had some guy who was trying to get in here and he wanted to talk to me for some reason. I guess he's seen some of my classes or one of the sales guys talked about me. He needed to make 10% a month on his entire portfolio. That's 120% on your portfolio in a year. He needed 10% a month on his portfolio, return on his portfolio. Are you smoking crack? You wanted to make 10% per month on your entire portfolio. Those are really good goals to have. I think it's great to have goals, but those are completely detached from reality. You cannot, in fact, if you can make 10% in a year consistently, that's probably as good as the best hedge funds managers are doing. And you'll hear stories of somebody who's exemplary doing 20 or 25%. And of course, you'll hear stories about people, hitting a real home run and getting a double or triple in a year, but consistently setting a realistic number. My target had been 7, and I've actually done better. So my goal actually is lower than that now. So I'm more of, and it's not just a return. There's also a preservation of capital, which is important to me. So getting to a point now where thinking about not having an income anymore and living off of my retirement, I got to make sure that nest egg doesn't go away. So I start looking at other goals. When I first talked to a money manager, I had my first job out of college, and I had this guy call me, free dinner or whatever, you get them too. And this guy was like, well, what are your goals? I said, what do you mean? What are my goals? I want to make a ton of money. Like, what else would my goal be? And I didn't realize that other people have goals that are different. So preservation of capital, generating a monthly income, getting your portfolio to grow. Those are all different goals, and you need to figure out what your goal is. And so, ultimately that needs to boil down to some sort of a number that you need to hit. So looking at that number and being realistic on what you need to get there, and keeping in mind, I do think while there are some strategies that can give you regular paychecks, once every 2 weeks or once a month, I would not personally. I wouldn't feel comfortable if I needed to pay a mortgage and needed to generate so much money every month. That would, because I know that there may be months where I might not have any growth or any take-home pay, but other months that will make up for it. Madam Cleo. Oh, looking into the future. Is that what Madam Cleo does? So it can be difficult to keep track of what your cost basis is. So like I said, you need to know where you're at to figure out where you want to go. Like I said, I think some people, if you get to the point where you've done all this and you're comfortable with it and you don't want to keep track of your individual trades and you're hitting that number in the bottom corner, then fine, probably okay. If you've got something that's working out for you. And I think that you've probably seen the consciousness competency matrix. So the consciousness is how aware you are. The competency is how good you are. There's a 2x2 matrix. And where you want to get to is in that fourth quadrant where you are good and you don't even have to think about it. You're a natural. You're just executing, banging out trades. We all start in the unconscious incompetent box, which means we don't know that we don't know. We become aware of our ignorance and we become consciously incompetent. So we are not good. but we know we're not good, and so we get better and we don't make any more mistakes. Then we get into what we call the consciously competent. And that is where I think of Daniel Kahneman's System 2, where you're very much thinking proactively about what you're going to do, how you're going to trade. And in that place is where you need, in order to get to that box where you're automatic and just not even thinking about it, you have to go through this box of being consciously competent and very intentional and very direct about what you do. And you have to go through this phase, I think, of tracking your trades. I don't know of any other way to do it. So following the 6-step process, every single one of the steps, doing your due diligence, defining your exits, of course, and tracking your cost basis to make your adjustments. So my goal is to give you a simple tool or a simple approach on how you can do that so you can better track your trades. This does require a little bit of knowledge on Excel, Microsoft Excel. Certainly the same exact thing could be done on any one of the free spreadsheets that are out there. So Open Office or Apache.org, I think, or Google Docs, you can get those for free, and you can do exactly what I'm going to show you, and the methodologies are the same. And those applications. I do like Microsoft Excel. That's kind of a standard. And of course, you could use Numbers. If you have a Macintosh, that works as well too. So this is an example of one of the trade trackers, and I'm going to go through some of the basics here, and then we'll go from scratch and start one from scratch. So the idea is that you would use this over time. And so the convention that I personally use is to put an instrument in a row. So by the way, in Excel, Microsoft Excel, you'll see these letters A, B, C, D, etc., all the way to wherever, and 1, 2, 3, 4. So this is row 1. This is row 2, row 3. The reason I mention that is, do you remember the game Battleship? You sunk my battleship. So, you looking at somebody they've got their battleships and submarines and tankers and aircraft carriers or whatever hidden, and you say, B-17. And so then they would put a pin in that quadrant, and if it was a ship, they would say hit. And if it wasn't, it'd say miss. And so anyways, those quadrants are the same thing here. So we have rows that are numbers and columns that are letters. So I said B17. B17 would be, this box down here. So Bravo 17 would be that box. And that's important when we look at the formulas because we are pointing to those cells. So I have each row, and I start with putting, is it a put, a call, or strike? And I write it out. Now, I've seen people do these trade trackers where they have in one cell. So this is cell A or alpha 2, and this is cell B2 and cell C2, etc. The reason I have those numbers, and I could put all of these things in one cell, but I couldn't do math on them. And what I want to do is do math on the strikes and do math on the expirations. And in order to do that, I have to have them in different cells. So each row is a different instrument. Each column is I set it up to be a date of a transaction. So something happened on that date, and of course I put the date up here. Now I've done different things where I put like the stock price. I actually had people ask me a while ago, said, gee, it would be nice to know what the stock price was on that date. And I don't do that. It's a pain to keep up with that. Go look at a stock chart if you want to see what the price was. You can go pull up your platform or whatever and say, well, on April 24th, or November 24th, what was the price of whatever this equity was? I guess it doesn't do me any good to have it in here. I don't need it for my cost basis. It doesn't help me out. So I don't do that. Now, there is other information that goes with this trade. There is, when I make an adjustment, I do write them up. And of course, you've followed my trades. If you have followed my trades, you know that when I make an adjustment, I explain what changed. So I go through the due diligence, and that's not what I'm going to talk about here. I'm not going to talk about the due diligence of making adjustments or making trades. And that's an important topic, but it's not what I'm going to talk about. The other thing that I do is I keep track of this on a per share basis. So on a per share basis. So whether I did 1 contract or 10 contracts, I just put it in here on the per share basis. Now, if I was not using this for teaching purposes and sharing these trades, I might decide to do this in the absolute dollars. And then at the bottom, do a division that would put me on a per share basis. And that might work a little bit better for you. The reason this works out great doing it on a per share basis, as long as I don't change the number of contracts or the number of shares that I have. What I mean is, let's say that this was 10, and so that it's going to end up being a credit of 102, so it's $102. And if I did a 10 of them, it's $1,002 or $1,020. If I did 1, it's $102. It doesn't really matter to me how many I did on a per share basis. The percentages, the ratios, everything's going to work out to be the same. Now, if I was not sharing this, if this was just me, I might add another field and say number of contracts in here, and then have this multiplied out by the total dollars. So it'd be a credit of $173 and a debit of $71. And then down here it would show $102. And if I did 10, then it would be $1,730 and $710. And then down here it would say $1,020. And then I might divide that by the number of contracts to show my per share basis. The other thing that you might decide to do on here, which is not a bad thing to do, is to include commissions. And sometimes I do go through and I'll add a field in for commissions. I like keeping it, well, I'm not sure what you mean by if I leg in or leg out. Is that as far as keeping track of the total cost or the per share basis? Is that what you're talking about, Fritz? So the other convention that's in here is the positive numbers are credits, negative numbers are debits. So this is something I bought for 71 cents, and that is something that I sold for 73 cents. So I can tell what it is by looking at the sign here, which is important to be consistent. If I sold, so if I did, like I said, I did 10 contracts and I decided to close out of 5 of them, then things get a little bit, messy if you're doing ratios. If I did that and I kept track of this, I would make an adjustment down here. I'm not going to do that right now. I'd have to think that one through all the way. Yes, and that Scott says I do keep track of that on this spreadsheet. If I change the number of contracts, but it does require making some adjustments, either making adjustments going forward or making an adjustment going backwards, to make sure that my numbers are reflected. All right, I might make some note if I did that. Usually, I'm not doing ratio spreads or like ratioing out where buying 10 contracts and then I'm going to close 5. I'm usually closing the whole thing or not. Not that you couldn't do that. The other thing on this spreadsheet here on the far right is I have the total for the row. So I can look down here and I can see what my transaction cost was, the net transaction cost on each position. So I netted a credit of 173 on that short put. The next instrument, I netted a profit of 170 on that was a long put. I bought it for 71. I sold it for 241. Whatever that next thing was, I lost money on it. I'm betting it's a long put. Yeah, so it was a long put I bought for 609, and then I sold it for 535, and then apparently I bought another one again. Or oh no. How did I sell it twice? Oh yeah, this one I bought it twice. I did keep track of it because I bought another one here. So I had two on this one. Yeah, so I guess this is an example where I had two long puts because there's one, there's another one, and then I ended up selling them both for lower price there. All right. So, the other conventions, I mentioned this. Yeah. Negative means that it's something that I paid for. Credit is something that I sold. So going down what's below here, I have a couple different totals. So one is a total of the column. So I can look on the day and say, what was my net credit or debit for the day? I'll also keep a running total of my net cost basis, and I'll show you where that is on the next slide. Then down here, I'll add in some other columns, and we're going to build one of these from scratch. By the way, does anybody have a trade that they want to share, or we can just wing it? If somebody had a trade with adjustments or something that they knew their cost basis on, of course, would have been nice if you were prepared ahead of time. No, if I prepared you ahead of time, I would have had to tell you. I don't know if anybody has an idea. We can wing it if you want. So we have the duration here. So the duration would be the difference between the day that I placed the trade and the expiration. Of course, that duration could change, right? When we make an adjustment, we might add more time. Fritz, if you got one, I can, if you want me to, take a look at it, and we can. I'll just build it off of your numbers and build another one the way that I would do it. And then, so here the max risk, and this is what I talked about, the max risk in this trade. So this happened to be a bull put. I know that because I received a credit for this 116 put, and I bought a 112 put, and the net credit was $1.02. It's a $4 wide spread, and so the maximum risk is going to be the spread less the credit that I received, and so it's going to be the difference between these two less this, and it's a risk, so it's expressed as being negative. My maximum return in this situation is the cost basis. Now, the max risk and the max return, this is where it gets a little bit tricky, because you need to, and this is actually a really good effort, I think, for you to go through. You need to understand what your risk is. So I think you need to be calculating it based on what you have open at the time. So if you have, I might have some other positions here. Maybe I did an exploding bull put where I had a long call. So I would need to figure out what my maximum risk is. I knew who it was, Weisenheimer. So I need to be able to calculate the risk, and I'll show you the spreadsheets, and I'll show you the basics of the formulas of where this max risk. So this is one that you need to be comfortable knowing the position you have. How do you determine your risk? Which you should be able to go back and refer to your, to the notes. If you've got a diagonal trade, or you've got a vertical trade, or an iron condor, or whatever the trade is, calculating there. As soon as you do that, she's going to scratch. My wife just closed the door. The dog's watching my wife walk away. Then the dog's going to look at me, and she's going to start scratching the door. Okay, so calculating the risk and the return requires a little bit of knowledge and understanding of the trade you're in. So at 8.9, you should all have a good handle. You're in level 8, so you should all have a good handle on that. Then the return is calculated here. Now, the return is calculated based on this divided by this. Now, you notice the number is positive, and I have to turn it into a positive because that would be a negative number. And then the annualized ROI is going to be calculated by using this ROI and considering the duration. So that's the gist of the way this is set up. And then let's say that I made an adjustment. So here is an example of the first adjustment that I made. And what did I do in this situation? So the short put is still in place. On December 9th, I did nothing. Now, I would, in another place, keep track of why I'm making this adjustment. The stock, crossed down below my break even, and now it's time to make an adjustment because of technically bearish or whatever I decide I'm going to do. So in this situation, what I did was I didn't do anything with the short put. I left the short put here. The long put I closed for 241, so I made 170 on it, and I bought a March. Oh, my daughter's home. A March long put for $6.09. That was a debit. So this was the roll that I did. I rolled this. So I'm guessing, I don't know, but knowing the way that I buy puts, the stock dropped down to 110. So I bought the at the money put without ever thinking about it too much, and with 90 days till expiration. About 90 days till expiration would have been what I did. So actually 116 days till expiration, you can see it there. So so this math is going to be, the duration is going to be the beginning of the trade minus the longest one of these. And I'll show you how I do that. So now this is a total for the day down here, this total cost basis. That's technically not my cost basis. My cost basis is actually down here. This is the total for the day. So that adjustment cost me $3.68. And then this column here is the total that I have into the trade. And that is a sum of all of these things here. It should be. No, it's not. I don't have my cost base in. Okay, this is an old one, so we'll calculate it and show it to you. Now, I have this other column over here, this estimate column, and this is where I do some math to say, well, what if I can get, $2 for this and I have to pay $3 for that? I can do some math to determine. So this right now is showing me that if everything expires worthless, I'm going to lose 266. Okay, so that is my cost basis. Okay, I see where it is right now. So my cost basis is here. So I used to keep the cost basis in that column, but what I really want to know is what's my cost basis on each day. And so I'll show you how I do this a little bit differently now. Now, you'll notice that my max risk and my cost basis are different. So in a bull put, it's the spread less the credit. So the spread here is 116 and 110. So the spread's $6 less the credit, but it's not a credit. It's actually a debit. So that's where that 866 comes from. This is now a diagonal trade, a bullishly biased put diagonal trade. And the risk of it's similar to a bull put, but calendarized. So that it's a bull put with the long out further than where the short is. And so in that situation, if it was a bull put, it's the spread less the credit. But in this situation, it's a net debit. So I have to add the debit to it. And that's what that is there. Now, the return is not able to be defined, so then I don't go ahead and do the math on that. So let's take a look at what we got here. Okay. Both of these look pretty good. Fret's nice. I like it. Ooh, I like it. Jess is in a little bit different format, and hers came in first. So I'm going to run with hers. And so I'm going to start from scratch, and I'm just going to build a spreadsheet from scratch. Now, I wish that I could give you guys the knowledge of how to use Excel. So I'll try to cover the basics. And if there's something that I did that you're not clear, if I went too fast, just let me know. So as I said, here's my rows, here's my columns. So just navigating and moving things around, you'll notice that there's a little square down here, and I can drag and do things if I click on that square. If I'm trying to copy or redo some things, I don't know that I'm going to need to do that. I could, 3, 4. Oh, I'll show you how that works. So if I wanted to continue that pattern, I just go like this, and it's automatically going to continue. And then going like that, I can copy as well. Well, we'll cross that bridge when we get to it. So sometimes I want to know what my number of adjustments are. Now, the other thing you should know is that you can insert, home. Okay, right click, Control Z or undo will undo anything you did. So if I did a bunch of goofy stuff and I didn't want to do it, so, I didn't mean to do that. Control Z, Control Z, Control Z, it'll undo. So remember, get to know your undo key. If I wanted to insert more columns, I just right click and say insert. If it's obvious that I want to insert a column because I have the whole column selected, so I can go here, click the row, click a column. So if I click a row, if I wanted to put more on top of that, I just say insert, it's going to know. Now, if I'm here and I say insert, it's going to say, do I want to put in a row or do I want to put in a column? And what do I want to do? Do I want to just shift this down? I just want to squeeze something in there, or do I want to shift the whole roll down? So if I just want to shift that cell down, I can, let's say insert. So that's just going to move that one cell down. Or I could say insert and put the whole row down. So then I can put a new row in there. So whatever works. There's multiple ways to skin a cat on this thing. So you can, I just did select all, Control A and select all. I could have easily gone here and done the same thing. So, and then with regards to the undo, I forget where, there's somewhere up here is, file. Somewhere in here is undo. There's a way to do it with click on skin the cat. Okay. So there's also some stuff up here on the ribbon, and I'll explain some of this stuff. This key right here, this total key, we end up using that. So I usually start with a column, and I just to be clear, is it a put? Is it a call? Is it stock? You could write it out if you want. If I wanted to write it out, we could write it out. Put, call, stock. Now you'll notice that, I mistyped it, so whatever. There you go. You'll notice that it extends into the next cell. So if I had something in this cell, which would be long, short, that, okay, I can't actually see all of this. I can click here and drag and make that column bigger or shorter, whatever I want. Here's a handy dandy trick though. is if I double click there, it'll automatically resize that column to the longest thing. Now I can do that with multiple things too. So if I just, let's say that you notice that both of these are longer, if I click the whole thing, it's going to do it for all of the columns. It's a real handy way to resize them. Now you'll notice that these are different lengths. If I wanted them all to be the same length, I just move one and now they're all the same length. So depending on how persnickety you are, whatever works for you. Or you can do wrap text. If you wanted to do wrap text, that's a little bit more involved. So that would be format cells and then alignment wrap text. And then that's going to make the column wrap if you wanted it to wrap. I'm going to hit Control Z because I do not like to wrap. I like my rows to all be the same height. So is it a put, a call, or stock? I don't know what that is. Oh, is that what that is? Ah, there you go. See, I just learned something there. I didn't know that. So there's more than one way it is. We talked about that. Oh, I don't have, that's you. That's not me. So as I put call stock, and then I put the strike, and then I put the date. Now, if you want to change the format in here, we can make it bold, we can make it italic, we can make it underline, we can do all kinds of different stuff there. Sometimes I'll make it italic or bold. And then these are headers, so maybe bold would be the appropriate thing to do. So this is technically the expiration. Now, so the first trade I would put in here, and this would be 2018. Now, oh no, wait. 11/27/2018. So that would be the date of the first trade. The expiration, and then we're going to put in here of 1/17/2020. So you'll see on here that we can change the format of the date. There's a number of different formats here. So if I wanted to go to long date, and this changes the format. Now the number's still the same. You see it's still January 7th, 2020. But if I wanted to change the format, there are different formats to express dates. So if I wanted the month in there, we can make it customized. You can come down here and say more formats and date. So here's all the different, if I wanted it to be, Jan 14, or what if I want the month and then the day, the month, then the day, then the year, I could spell it out like that. So you can change the formatting if you wanted to. Like I said, it's still the same number, but whatever works for you. So we're going to start with a long call at strike 23, that expiration, and 360 is the price. Now, right off the bat, I made a mistake because this is a long call, so I need to enter this as a negative because I'm buying it. Now, you'll notice that format there looks a little bit, that doesn't look like money. So I could click here and that quickly puts it into the money format. Now, you might not like a current accounting. There's also currency. You might prefer the currency where it's got the negative on the outside. I just use this format here. So it's a negative, so it's got a parentheses around it. So on just a long call purchased on that day. So on November 29th, now I don't have to finish the date. It's going to put the date in there, and it's decided it likes this format better. So if I want that same format for all my dates, which I do, I'm going to do a right click, copy, and you'll see this format painter here. And I'm just going to drag that all the way over here so that all of my dates have that same format. So you can copy and paste things. So you can copy and then I can paste. I can paste different things. I can paste the numbers. I can paste the formats. In this case, I'm pasting the formats for the dates, for the subsequent dates. Now, you notice that when I zoom in and zoom out, that's on, oh, now I can't see this anymore. So maybe what I want to do is double click there so I can make it more visible. And double clicking that column will help to resize it. So down here, I like to keep track of that other stuff. So somewhere down here, I'm just going to start creating my risk metrics and my profit metrics and the duration of the trade. So I'm going to start with so total, and then I'm going to have a net cost basis. So the total, what I'm going to do, and this is a really handy tool, is this little sigma, this thing that looks like a, well, it's a sigma, which is the Greek letter for sigma. Sigma represents a sum. And so if I just click that, it's going to create a sum. Now, you'll see what is known as a function. The function is sum. So it says equals sum parentheses D3 through D10. So it's going to take everything in that column. Now, you know, I don't have anything else in that column, but maybe in the future I will use the space. In fact, I'm going to populate the rest of these. Now, if that's not enough, if I need to add more in, no problem. So that's going to take my total, and you see the formula there is D3 through D10. And let's say that, you know, way out here, I'm like, well, gee, I wish I had more space. I can add more rows. So I just select how many rows I want to add. I want to add 4 rows, and I do right click, insert. Now, here's the cool thing. You notice that this formula now is D14 instead of D10. So it knows that I want to total everything between this cell and that cell, and it's smart enough to adjust the formula. So that's my total, and I could undo that if I wanted to not. Do lots of saving, undo if you need to undo. So file, good idea right now to say save as, and you need to come up with whatever convention works for you. For me, I keep my animal trades. So I have a trade here, and I label them by whatever you want to do. I don't know what you do, but I would start with, let's see. Why won't you let me do that? New folder. And I'm going to name the trade. And I normally name it by date because this allows me to sort really quickly. So 11/27 XYZ long call. Now, I'm not a big fan of abbreviations for you guys. I usually spell it out, but for me, I use abbreviations. And that would be what I also decide to name the file as. So 2018 is 11/06 XYZLC. Now, I could have done this in terms of, so if I did 3 of these, you know, I could say, you know, here's where the math comes in. If you want to do formulas, I could say equals 360, and let's say that I did 3 of them, and I want to keep track of this on a net cost basis, not on a per share basis. So this would be if I did 3 contracts times 100. So that would have cost me $1,800 or I'm sorry, $1,080. I could do the same thing, and then if I wanted to say, well, I actually had, we could do another column if I wanted to figure out what my net cost basis per share was. I could just come back and divide that by 3, or actually 3 and divide it by 100 as well. So that's 360. So I could go back to the per share basis if I wanted to do it that way. We're going to stick with this convention because I think it's easier. Thoughts of have multiple trades as one file, different trades. I think that's probably a lot cleaner. I think if I were you, I'd probably do that. Especially, maybe I would have one for XYZ and have another one for ABC, and then just keep all the trades on one tab. That would probably be more prudent. For me personally, that's what I would do. All right, so on the 29th, we made an adjustment here. There's no question I would do multiple sheets and then one tab or whatever works out for you. The other thing, I'm a big fan of using Dropbox. Very secure, good way to share files. And if you ever find yourself away and you're like, oh man, I need that important file. For me, Dropbox is very handy. So I have Dropbox is like a folder. So I have all kinds of stuff you might need. Stuff for Connor, stuff for my son, Trader away. So there's Jack, I usually don't. That's one of the things. So Jack says, do I ever place a column for number of contracts? So both per share and columns. I have done that in the past, so then you have two columns for each date, and it just gets a little messy. You could definitely do it. I do make sure that the numbers that I calculate here line up with what's in my portfolio. So I reconcile it that way. So my net cost basis in this situation is actually going to be the same thing. It's going to be, for now, it's going to be the sum of this through this. Now I'm going to do something a little bit different. I'm going to come over here and I'm going to create what's known as an anchor. And using the $sign, I can anchor this cell so that when I copy and move this in the future, it'll always start with D3. And the way that I do that is I put $1 in front of whatever I want to anchor. And technically, I just need to anchor the row, but I'm also going to anchor the number just because that's out of habit what I do. So what I'm showing you here is when I drag this across, you'll see that this column, this formula here is going to only total what's in that range above it. Whereas this is the same thing for this date, but that's because that's my first transaction. But I really want to do is total up everything that's in here. And you can see that that's what that does. By me anchoring this first date, it's always going to keep that one, and then everything else will be by reference. And eventually what I want to do is get to the point where I just drag, this everything. When I get all my formulas set up and right, I'll just go like this, go bloop. Oh, wait, no, wait. Bloop. Copy the whole thing over here and then just fill in what I need to fill in. And then I can keep adding on more. So right now this is good. So I got my my total for the day. You might want to say for the day if you want daily. I don't know if you want. Sometimes the reason I don't say daily though is there's been times when I've made more than one transaction in a day. So I've had the same date twice where I bought and sold in the same day. So it's not really the daily total. It's just the total for that column. So the net cost basis is here. Right now it's a long call 360 is the net cost basis. So the next thing that I start to look at would be, let me, I cheating? No, I'm not cheating. So the next would be the max duration. And if I miss something or you think something else, like I said, some people up here might want to put the price. I don't need it. If you want it, that's great. I don't know. It becomes a hassle. So now I want to know the duration. And the duration is going to be this minus this. That's pretty cool if you notice here that we've got the colors. So this is going to show me C3, which is in blue, minus D2, which is there. And so it's 416 days is the duration. Now, if I wanted to divide this by 365 to find out how long it was, I could do that too. But I don't want to do that. I just want to keep everything in days. My maximum risk is going to be calculated here. And this is where you have to be comfortable with doing different formulas because it's going to be different depending on what position you have in, and you're going to have to think it through. So right now, the max risk is equal to, and this is going to be equal, it's equal to the total that I have invested. So either one of these columns is what I'm going to point to. Right now, I'm going to point to that one. So it's going to be 360. That's the most that I can lose. My my max return is infinite. So it's a long call. I have no limit there. But what I do like to do is to determine my return on risk. We talk about return on investment. I think return on risk is the right, because it's not always your max risk. Investment is not always your max risk. So return on risk is going to be equal to, now this is where the negative comes in, and I'm not going to use it now. It's going to give me a bad number, but it's going to be the return divided by the risk. And there's a negative sign in there to make it positive. Now it's going to give me a bad number, but if I wanted to test it, let's use 360 there, and that should be 100%. So 1 is a percent. 1 is 100%. So I want this to be expressed as a percent. So I need to have the percentage there. Now that's wrong because the max return, which by the way should have the same format as this. So I'm going to right click, copy format. Oops, no, I don't want to. Right click, copy format, paste the format. So the return on risk, and then there's annualized ROR. And that is calculated as taking the return on risk times 365 divided by the duration of the trade. And again, that should be a percentage. So we'd be making 88% if that was our max return. But it's not, it's infinite. And when I put infinite in here, it's going to just say value error. So just got to deal with it. You can't put infinity in here. All right, so let's look at what happened on the 29th. So on the 29th, a position was added. We added a call, and we sold a call against it. So this would be the 1950 call for the, I actually don't like that format. I just like a regular short date format. And I'm just going to click that whole, well, I'm going to click all of this and make that a short date format. You notice I tidy up all the time. I'm always like messing with my column widths and stuff, and so I like to keep things tidy. So call strike 19. The expiration for this is 12/21. Now here's the 12/21. If you what happened there? Wrong button. 12/21. Now that's a convention for entering dates, and it's assumed that it's the current year. So Excel is smart enough to figure it out that if it's going to think this is the current year, and so it'll put the 18 in there for you. And the net, this is going to be a short call that I'm going to sell against it. So it's going to have a credit, right? So it's going to be a positive number. So 35. So now this is kind of cool. That's where I pre-did the math out here to show you. This is the total for the day. I brought in 35 cents on that date. Or did we did another transaction too, didn't we? Same time. So there's another transaction that was done too. A put was added at the strikes 17 with the expiration of 4/18. Now, if I just do 4/18, it's going to be 4/18/18, but I don't want 4/18/18. I don't want that. I want 4/18/19. So be careful on that. It's going to go to whatever the current year is if you just do the short date. And that is going to be a debit of 109. So my net cost for the day is 74 cents. My cost basis on this trade, now that everything's open, is 431. Okay, so now I need to start thinking about what's going on over here on the right. And this is where I'll put the total for that row. And I'm going to hit sigma again, and it's going to tell me the total for each one of these. And I'm going to take that all the way down to here, and then I'm going to do a total for that row as well. So this number here, that's my cost basis. And I used to always keep my cost basis there, but that doesn't show you what your cost basis was on the date, which I like to do now. So this is always going to keep a running total of my cost basis. Now my cost basis, this is my cost basis as of that date. Happens to be the same number because I have no other transactions there. So what else do I do over here? So I add another column over here sort of for scratch pad. So estimate. And what I'll do is put a total, gain, loss, max, risk, return on max, risk, max, duration, and then annualized return on risk. Now, I don't have the columns quite lined up there. I probably should make them line up. Here's a cool thing. It's I got cost basis, the total. The gain loss is really my net cost basis. If I wanted to have these all on the same row, I could just boom, 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 just drag them down here. So you can grab cells and move them around. I think, yeah, that didn't move my cells the way I wanted to. So what I should have done was inserted 1, 2, 3, insert, shift cells down, and now my formulas will be adjusted appropriately. Yes. Okay. So I should have just, why did I do that? I'll just, Now, one of the other things from a formatting standpoint, you notice that I don't want to, I like this because I'm going to be doing some math over here. So I don't want this to be left justified. I want it to be right justified. So here's the alignment. And if I go like that, boom. If I wanted them to be in the center, I could do that. Some people like that. Some people like this. I do like things to line up. Yeah. So the total is going to be, I don't want that total. You're grabbing the wrong field. I want the total to be there. Oops. No. Yeah, there you go. There. My cost basis is going to be this field here. The maximum duration is going to be, now here's a cool thing is I can say equals max, and I can say a range, and I'll just say everything in there. So it's going to pick whatever my maximum number is, because my duration might change in this. But I sometimes like to look at max duration and also look at my max risk for the trade. You know, sometimes I see people say, oh yeah, I have this really cool, great ROI. But yeah, it was on a, because you bought a put, your risk was really low, and you had all this exposure. I look at all the worst case stuff. And the max return, let's figure that out later. We'll do all these later. Once it's closed, I forget it. But I mean, if I close this position and I have a shorter term long call, I look over here, I want to see the risk, the worst case scenario, my worst ROI, my worst annualized ROI, everything bad, everything worst over there. Because it could be that I have to stay in the trade for that long. So I look at worst over here, and I might actually do better. Okay, see you later, Sam. Tell her I said hi. Let's see. So what I'll do in here is start putting in, like, what if I can sell this for $6? And that total isn't, what? Oh, I know why. There you go. No. So I'm going to add this to this. There we go. So this is my net cost basis based on this estimate. So what I'll do is, so if I want to try and figure out how much this will allow me to figure out what I need to, sort of what are my targets to get to where I need to be. So the return on risk, and why did we don't have maximum risk? Because we don't have it all calculated yet. We will get there. Okay. So this is going to be equals minus this divided by this. And that's going to be expressed as a percentage. So max, oh, no, it's dollars. Oh, wait, did I do that right? Now max return is going to be my net cost basis here. It's the same field. And the return on risk is going to be minus this divided by this. And that one's a percentage. And then the annualized is that times 365 divided by the max duration. And again, that's a percentage. Okay. So now if I got, let's say that I can close this for $6, that's going to allow me to calculate I'm not worried. I don't really care what it was. I just wanted some trades to put in here and some prices to put in here, and we could calculate risks and build this thing. So this allows me to do some what ifs over here. Like, okay, let's assume that, this expires worthless. Okay, so that's going to be 0. And this is now worth, $4. That means I need to get 34 cents out of this one. So if I can get to 34 cents, now I can at least break even. But I don't want to break even. I want to do a little bit better. So I need to get about 55 cents. So this little corner over here helps me figure out what what I'm trying to get to. So if my profit was 100% ROI, well, then now I need to get like $8 out of the two of them to get 100% ROI. So this is just sort of a what if. You can use this to sort of figure out where you need to be to get out. You can do it other ways too, but that's what I usually have this estimate column for over on the far right. So let's go back over here. We didn't finish up the whole situation here. So we have the total for the day, and I don't have that same format. So I'm going to click here, copy, and make sure everybody in here gets that same format. Okay, so everybody has the same format. So we sold a call for 35 and we bought a put for 109. So, and now our duration is going to be this is still the longest in there. So the duration is going to be the same. Again, now I forgot to anchor. So I'm going to anchor D2. And I'm actually going to, I'm going to anchor all of these so that when I copy it over, it's going to use exactly the same formula. If I didn't do that, it would have done something goofy because I'm going to continue to copy these formulas. So in the beginning, if you want to anchor or not, if you're going to be copying, you might want that. So the maximum risk is equal to there, and it's actually the same calculation. The maximum risk is equal to that. No, it's not. What's the most that I can lose on this trade? So what do we have? We have a debit spread. No. So we have a in the money. Let me think about this. I'm trying to think, but nothing's happening. So I think so. Normally with the synthetic collar, the short call is at a higher strike than the long call. Am I right? Yeah. Okay. So that's it's a bear call diagonal. So this is where we need to get a little bit creative on the risk. And so we have the risk is going to be equal to the spread, where I have the right to buy the stock at 23, but I have an obligation to sell it at 19, right? So I have the right to buy. No, wait, let me make sure you get that right. I have the right to buy at 23, but I have an obligation to sell at 19. So that's backwards. Yes. So the risk from the spread, it's a $3.50 wide spread. It's going to be that plus the net cost basis. So the risk is 784. So this is the total that I have into the trade. So if it was a credit, it would be the spread less the credit, but this is the total that I have into the trade is as a debit of 434. So it's going to be the spread where I can buy the stock for 23, but I have an obligation to sell it for 19. So that's a debit and that's a credit, and that would be the maximum risk. Now, again, this doesn't have infinite risk, but it doesn't have defined risk. It's undefined risk. So the risk, on a calendar trade or a diet, let's just say that they're in the same month, would be the spread less the net credit. Happens to be a debit, so it's plus the debit, and then the risk of a long put is the debit of the long put, and so that's all in there. That's why I like keeping this cost basis in here. You can just look at where's the source of my risk. Well, wait a minute, hold on a second. But I have the right to sell the stock at 17. Nope. So the put would have to be higher than 1950 in order for me to have a different risk there. And that's a right. Yeah. Okay. All right. So on 12/6, we're going to oh, why is that there? So on 12/6, we are going to close the 1950 for $6. Is that correct? So, no, 6 cents. Okay, so we are going to buy to close it for, it's negative. So I sold it for 35, and now I'm going to buy it to close for a 6-cent debit. So on that call, I ended up making 29 cents. Now here's the other thing that I do when I close a position is I'll shade the area. I'll come in here and go like this and shade the area so that I know that that position is closed. Now here's another little trick as I try to keep those white. In my coat pocket. Blue. I don't know. So again, this should work if I just copy Now, I didn't put anchors on this, so that's going to screw up that formula. So I'm going to put anchors there, and then we'll edit it later if we need to. So I can just take this and drag it over to here. I'm going to take this and drag it over to here. So let's just make sure that our math is right. Yes, we increased our net cost by 6 cents. And so our net cost basis has now gone to 440. The max duration is still those dates, so we haven't changed that. It's the date we entered the trade and then the longest date option here. The maximum risk is now going to be, yes, it's the same. No, it's not, because now all we have on here is a long call and a long put. So the max risk now is going to be equal to the debit, because I no longer have the risk from the short call. So now my max risk is that. My max return is now infinite, so I am not able to calculate a max return here. So also on that day, oh, I didn't do everything that happened on that day. So the put, the stock went down, so we were able to close the put for a credit of 151. And so what I'm going to do here is copy this format and paste that format there. So now it's shaded. I don't know if that's dark enough. It doesn't look very dark. If you want to pick darker, pick darker. There you go. I like that. That's a little darker. So I know these positions are closed. If you wanted to do something different, draw lines through them or put a check in the box or something. But now I know that all that I have open here is the call. And I can also tell because I have matching transactions. So there are, those are closed. So the net cost on the day was 145, and now my cost basis is 292. And this is where I can come over here and say, well, what's the value of that call right now? Well, if it's still 360, I say, well, wait a minute. If I closed it today, or actually I put it in the wrong field. I put it up here. It doesn't matter. It's the same thing. That is going to get me out at a nice little 22% ROI if this call hasn't changed. Now, if it's gone down a little bit, which it probably has because the stock's moved down, I can do an estimate here to try and see what I need to get or what I'm going to make. So on the 10th, another trade was done. Three trades were done. Okay, so this is why I don't put the total for the day. So a 1650 log put, 12/21 expiration. What? So 11 days. Interesting. 11 days till expiration. Did I get everything? Wait. Yeah, we closed the put. Okay. 12/21 expiration. 1650 is the strike. It was purchased for a debit of 73 cents. And then in the same day, so now I'm getting close to my end. So now what I'm going to do is I'm going to insert. So I have more. Now, sometimes what I'll do is I'll take some of those columns and just make them really thin so that they're there and I need them if I need to expand, so that I can keep my real estate. And I want to try and keep everything on the same screen. So sometimes I might decide to come and close maybe some of these adjustments. I'd probably keep the original trade open, but I might come over here and, minimize some of those so I can't see them, and I can open them if I need to. Don't worry about it. I appreciate you putting the trade out. I just needed some numbers. We could have just, I was just going to randomly pick some trades anyway, so this is better than nothing. So also on the same day, so this is a closing transaction, so I'm going to keep it on the same day. Because it's closing. I could have just netted something out in here. I could have just net the position if I wanted to try and save on some real estate, but I want to try and be true and keep everything in here. I could also add, instead of doing date, I could add time to this. And so I could have done it, or I could even do date and time if I wanted to put that in there and note that, it was, one was at 10 a.m. and the other was at 2 p.m. if I wanted to, but whatever. So 73, and then stock dropped pretty quickly, and so we ended up 73 for the day, which means now my cost basis, and see that's the total of everything, all my transaction costs are in there, all my debits and credits and debits are in there. So the net cost basis is 362. Duration still hasn't changed. I don't have any options longer than that one, so still that's right. And this is what I do. I go through every cell and make sure that these calculations are right down here. And my max risk is now, I have a long put and a short put. Yeah. So my max risk is going to be the debit, the net debit that I have in here, because I have a long call and a long put. I'm sorry. So the max risk is the total of those two. Now what's happened is I'm going to close that for 110, and you can see I made 37 cents on that particular put, and the net cost basis. So the max risk on this is now still my net debit. So nice job of taking the debit from, and this position is going to be closed. So I want to come over here and hit gray. So it's closed. I know that it's closed because I got the matching transactions, and it's important that you look at these and make sure that you should have a credit and a debit, or a debit and a credit and a debit, just to make sure that that position's closed. It's possible that I bought more than one put, and so I might sometimes have three. I think on the other example that I showed on the slides, I had multiple puts, so I ended up buying extra puts, and so you'll see three on there. But I can go back and see the trade confirmations. I know what I did, and so we know what we did here. So these are closed, so those are closed. So I can quickly say now all I have is a long call. Originally paid $360 for it, and my cost basis is now down to $252. It's also here, also there, and again. But we also added another put here. So on the same day here, we sold that one, and we bought a 15 strike with 1/18/2019. Okay, now something goofy happened with the formatting over here, so I got to come over here and change that to white. So in 2019. I don't know why that does that. Let me see, call. Yeah, why does it do that? I don't know why it does that. It bugs me. Because it thinks that the last time that I did a call, it was gray, so it assumes that I want gray format. I don't want that. So on the 10th, the second transaction of the day, we ended up buying a put for a debit of 220. So now our net cost basis on this trade on that leap long call and this short term put is 474. Max risk is still the same. There's no return here. I mean, no infinite can't be defined because it's potentially infinite. So you notice that I use und and inf. So und means undefined. So it's a diagonal trade. It's undefined. When it's just a long call, it's infinite. And so we didn't ever have to define the max return on here because we didn't have a number. I mean, it's important to have a goal. And if I know that my goal is like if I'm trying to get to 20% or let's say 100% annualized, there is a neat trick. This is a little bit extra credit. I'll show it to you though. We could start guessing what would be the numbers that I need. Of course, I could just say 474, $8. I could. Oh, look, I got pretty darn close right there. 805. There you go. Would get me to 100% annualized. Now, there's another trick that you can use in here. There's a thing called add-ins. Data. There's if you go file, options, add-ins, there is a add-in called the solver. So it's usually down here and you can activate it, the solver. Once you activate the solver, what I can do, I'll show you how the solver works. This is cool. So solver would be set the objective, and that's this annualized ROI. Let's say set that one to a value of, let's say that I wanted it to be 75%. Let's just say 75%. So I want it to be a 75% by changing this cell here. And then I hit solve. Boom. And it's going to tell me that not only 721, but 721 0 3 5 6 1 4 6 4 3 8 8 3 4 7. Yeah, it's telling me that that's exactly what I need to do to get to this. So I do use that solver tool. It looks like it took a little bit longer than it does. It's really pretty quick. But if I know I'm trying to target a number, like, okay, let's say I want that to be 100, data analysis. I'm sorry, no, not data analysis. We don't want to do that. Solver, change this cell to be equal to 100%. By changing that cell, solve it for me. Okay, give me an answer. What? Set objective. Oops, wrong cell. Set objective that equal to 100 by changing that. Okay, solve. So 663 is going to get me to 100% return on risk. 763. There's my dyslexia. So this is tells a story. I can go back in time and I can see what I did. I can evaluate how well I did on my adjustments. With that, here I'm generating credit. That looks like a good situation there. I'm continuing to lower my cost basis on what I have. And so, so the cost basis between the two positions would have been 582, and now I'm down to 474. So good, sometimes bad, because you see how well you're doing. For me, when I say sometimes bad, when I look at my long puts, they're usually what cost me the most money. When I look over in this column, I go, okay, what did I make money on? What did I lose money on? Almost always losing money on long puts, but you need them. So, it's just like having homeowners insurance. So this is, like I said, a tool that I recommend you use. I'll file, save as. I already saved it. Save. So what I'll do is I'll upload this on the calendar. So if anybody wanted to download it, they could download it themselves. That's not what I want. That's what I want. There's some free tools out there. Microsoft Excel, Microsoft Office has some training that's available. You can. I just Googled Excel training, and there's plenty of places that'll charge you money. There's plenty of other places that are free. Khan Academy is really cool. KAH Khan Academy. Did I spell it right? KHAN Academy has all kinds of free resources in there. And I would guess that if you search for Excel, Microsoft Excel, that you're going to find normal distribution Excel exercise. Cool. I might go do that. Projects. I don't know if there's maybe there's a ton of stuff there, but there's all different levels of training that are available out there. A lot of it's for free. Just like options education, though, the free stuff's not always so good. You know what I mean? You know what I mean? Know what I mean? Choose file. File attachment. Choose file. There we go. The Microsoft stuff was actually frustrating me because I was looking, they're showing me all kinds of stuff, but you gotta figure it out. The best way to figure it out is to get out there and just start doing it. There we go. Where is the file? File, save as. Oh, I don't know why I'm having a hard time here. Oh, it's attached. No wonder. Okay, cool. Today is not the 23rd. My gosh, Christmas is coming up. Sorry, La. My name backwards. Funny. Nice. Assalamu alaikum. Yeah, sure. Whatever. Why would you do that to me? You don't know. You know I don't read Arabic. So live from New York. It's Saturday Night. Okay. So click there. You can download that spreadsheet. Yeah, if you need help, catch me in a live open forum session, or let me know if you wanted to. If you upload it to the community section, I'd be happy to help you out. I'm not going to do them for you, but I will help you. If you want somebody to check it or something's just not right, sometimes it's good to have another set of eyes on it. So I hope that was helpful for you. Because KH is an Arabic letter. Nice. See, I just need to go back to learn my Arabic and I'll be good. All right, everybody. Thanks for your time. Appreciate you being here. If you have any questions, feel free to follow up in a live open session or ask someone on the community forum, and I will see you soon.